ladies and gentlemen. Good day and welcome to the Expleo Solutions Limited Q2 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Asha Gupta, EY LLP Investor Relations. Thank you, and over to you, ma'am.
Thank you, Anushka. Good morning to all participants in the call. Welcome to the Q2 FY26 earnings call of Expleo Solutions Limited. The results and press release have already been mailed to you, and you can also view the same on the company's website. In case anyone does not have the copy of press release and presentation, please do write to us and we will be happy to share with you. Representing the management today, we have Mr. Ralph Gallison, Chairman and Non-Executive Director, Mr. Phani Sangirila, Managing Director and CEO, Mr. Periyakaruppan Pelaniappan, CFO, whom we will be referring to as Mani. Phani will start the call with a brief overview of the quarter and half year gone by, which will be followed by Mani, who will be giving you the brief update on the financials. After that, we will open the floor for Q&A session. As usual, I would like to remind you that anything mentioned on this call which gives any outlook for the future or which can be construed as forward-looking statements must be viewed in conjunction with the risk and uncertainties that we face. These risks and uncertainties are included but not limited to what we have mentioned in the prospectus filed with SEBI and subsequent annual reports, which you can find on our website. Having said that, I will now hand over the floor to Mr. Phani. Over to you, sir.
Yeah, thank you very much, Asha. A warm welcome to all the investors, and I thank you all for your continued trust in Expleo. As you would have seen the documents uploaded yesterday, we have seen a good quarter, and generally there is a positive outlook, which is the good news. We have registered 9% growth quarter on quarter and also year on year, with Digitech growing at 10% and our engineering services growing at around 7% growth. Similarly, on the profitability, we have moved from 12.8% EBITDA to 17.1%. Again, even here, the digital revenue profitability is higher than the engineering profitability. So primarily, it's a great quarter, and it is resonating well with the four-phase approach, which I have been repeating since the beginning of the year, that our strategy throughout the year has been on four major areas: growing existing accounts, focusing on selected geographies like US and Middle East, pushing our digital and AI services as differentiator, and working lean towards more operational benefits coming from reduced costs. So that is something which we have been consistently maintaining, and going one by one, the growth of existing accounts. The 20 top accounts have really contributed very well for us in achieving this growth. And our consistent efforts on markets like US and Asia both resulted in these two regions growing very well. On the AI front, we have started to see the results. I have told you even in my previous earnings call that we have made significant investment throughout last year, done several POCs, and this year is the time for us to start reaping the benefit which has started. Now I can say that there is a revenue ticking in for the AI services, and more importantly, bulk of our renewals that are coming in are becoming possible because of the promising AI journey that we have taken in. The confidence in our customers have significantly gone up by seeing us being aligned to the changing technology dynamics in the market. And we have, as a fourth point, we have continued to keep a very close eye on the operating expenses, and we have been at the lowest in terms of our bench, and we are maintaining it at less than 6%, which has significantly contributed to the margin improvements. Of course, the margin improvements have also got a boost from the forex to the scale of 2 to 3%, but bulk of those are a direct function of the revenue being growing and the operating costs and the bench optimization being done as a continuous process. We are really excited now with this boost to get into the last quarter, which might remain because the last quarter will have December furlough periods and holiday periods. But with this momentum, we enter into 2026 with a very good, healthy pipeline, and that is promising. As we speak, we are currently in the process of finalizing our strategy for 2026, and the entire team is bullish about it, and we have been in the journey of this strategy finalization, which will end by mid-December. And I can definitely say that the industries like banking, insurance, retail with QSR and defense continue to be promising, and our investments will be to ensure that we ride the waves of these growing industries. From the services side, that is from the industry side, those are the industries. From a services side, the digital services are growing, which have now gone past 53% of our total digital and QA services, if you look at. And our continued focus on AI and AI-infused services will be key for the success of our strategy in 2026. As I speak about the outlook on this growth and profitability, there is certainly an attrition factor which is now gone really up with the market slightly showing the signs of recovery. The attrition also has gone up, and hence we have put necessary measures in place to ensure that the larger team stays motivated, and we understand that this is something which we have to keep under control to ensure that seamless delivery is made to the customers. As I have been emphasizing, AI certainly becomes the focal point of our delivery, and as a part of this drive, we have started a major training, learning and development initiative with an ambitious project of getting 100% of our employees to be AI literate by end of next year. A comprehensive program in-house supported by external training programs has been put in place, which is mandated to all the employees, and the aim is at least a good chunk of our AI demands are fulfilled within the team without we have going to the market. So having said this, I can be very confident that this momentum will be preserved, this positiveness will be preserved, and as we go into 2026, we definitely would see a better growth and profit. I'll now pass it on to Mani on the financial update.
Thanks, Mani, and warm welcome to all the investors and analysts on the call. I'll start my update with the highlights for the quarter ended September 25 in comparison to the previous quarter. Our operating revenue for the quarter ended September 25 is at rupees 2,827 million versus rupees 2,596 million in the previous quarter, and this is a growth of 8.9%, primarily due to an increase in volume in our banking and financial services vertical from the Middle East region, and also on account of benefit from forex due to the rupee depreciation primarily against euro. Our total income grew by 10.8% to rupees 2,954 million in this quarter, primarily due to the higher operating revenue that I talked about and higher other income from the forex gain. At constant currency, our operating revenue grew by 6% to rupees 2,752 million in this quarter versus the 2,596 million in the previous quarter. EBITDA for the quarter is at 17.1% versus 12.8% in the previous quarter. mainly due to operational efficiency improvements in addition to benefits of higher revenue growth. Profit after tax is at 14.6% versus the 9.3% in the previous quarter, primarily due to the operational efficiency improvement and mark-to-market forex gain of 69.2 million in this quarter compared to the 10 million of loss in the previous quarter. Now I'll talk about the financial highlights of this quarter compared to the same quarter last year. Our operating revenue for quarter ended September 25 is at rupees 2,827 million versus rupees 2,593 million in the same quarter last year. And this is a growth of 9%, primarily due to higher on-site revenue growth from Middle East and US regions in the PFS and enterprise vertical, and benefit from forex due to the rupee depreciation primarily against euro. Total income grew by 8.6% to rupees 2,954 million in this quarter, primarily due to higher operating revenue at the rate of above, and it's partially offset by reduction in other income from forex gain of 69 million in this quarter versus rupees 96 million in the same quarter last year. At constant currency, our operating revenue grew by 2.4% to rupees 2,655 million versus rupees 2,593 million in the same quarter last year. EBITDA for the quarter is at 17.1% versus 16.3% in the same quarter last year, mainly due to operational efficiency improvements in our core delivery costs and optimized spends on non-essential and discretionary costs, in addition to benefits of higher revenue growth. Profit after tax is at 14.6% versus 13.1% in the same quarter last year, primarily due to the operational efficiency improvements. I'll now talk about the financial highlights for 6 months ended September 25 versus the same period last year. Our operating revenue for H1 FY26 is at rupees 5,423 million versus rupees 5,114 million in H1 FY25, and this is a growth of 6%, primarily due to forex gain on account of rupee depreciation against euro. Total income grew by 6.8% to rupees 5,610 million in H1 FY26, primarily due to higher operating revenue and higher interest income from higher cash balances. At constant currency, however, our operating revenue had a degrowth of 0.3% in this period. EBITDA for H1 FY26 is at 15% versus 16% in H1 FY25, primarily due to impact of wage increments, partially offset by operational efficiency improvements in our core delivery costs and optimized spends on non-essential and discretionary costs. Profit after tax in H1 FY26 is at 12.1% versus 11.3% in H1 FY25 due to higher other income from cash balances and higher other comprehensive income on mark-to-market forex gains. Earnings per share is at rupees 38.78 in H1 FY26 versus rupees 38.26 in H1 FY25, and this is higher by 1.4%. Cash position stood at rupees 303 crores as of September 25 versus 276 crores as of September 24. And that brings the financial updates to an end. Back to you, Asha. Thank you.
Sir, we'll start with the Q&A.
Yeah.
Okay, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Jalaj from Swan Investments. Please proceed.
Yeah, thanks for the opportunity. Hope I'm audible. Hello.
Hello. Yeah.
Yeah, I hope I'm audible.
Yes.
Yeah, you are audible.
Yes.
You are audible.
Yeah. Congrats on a decent set of numbers or a good set of numbers. I just wanted to check one thing. Firstly, you mentioned the constant currency numbers. What would they be for this?
Sorry, can you repeat? What would they be for?
What would be the constant currency growth sequentially for 2Q F26? You alluded to a number in between. I missed that. Yeah.
Yeah. So I talked about it in my remarks. At constant currency for this quarter, compared to the previous quarter, we have grown by 6%.
6%. Okay. Okay. Thanks for that. And sir, I just wanted to have some flavor on the growth. If you could talk about from a perspective of verticals and how should we see the demand scenario from here? Any improvements in the demand scenario because the headcounts the headcount has increased after a long time and the top line the headcount is stable right rather and the growth has come after a long period of time. So could you give some flavor to that?
Yeah. So we continue to see a bullish behavior from industries like the financial services, insurance, and defense. So those three are continuing to be promising. And as we enter in 2026, we have a healthy pipeline primarily coming from these three areas. And we continue to stay invested in our efforts to convert these opportunities into material business. So that is a given. And as I said, our benchmark of growth is purely on revenue and profitability at this point of time because the kind of the technology transformation that we see, I mean, if I can achieve the same amount of revenue or much more revenue with the same number of headcount, that is what I would aspire for. So headcount not growing is definitely not an area of concern anymore on that. And we are significantly seeing a change in our the place where the delivery revenue is coming from, and our on-site revenues have significantly increased in Middle East. So that it definitely is promising. And within those three verticals, industries that I have mentioned. So that's where the industry position is, and that's where the headcount position is, if I have answered your questions.
Understood, sir. And sir, specifically on the growth or the what split of our revenue would be coming right now from the parent?
The direct would be around 70%, and the group business is around 30%. That is the internal.
Got it. And what sort of growth are we seeing? If you could give some flavor to that side of the revenue or from a parent and a outside. Could you give some flavor there? Yeah.
Both are growing, whereas the parent's revenue growth is primarily because of the forex, because the billing is coming on the euro side. So that's where there is a huge gain, whereas the headcount has marginally declined, I would say. But from our direct business, it has been very healthy.
Understood. I'll get back in the Q&A. Thank you.
Thank you.
Thank you. Before we proceed with the next question, a reminder to the participants, in order to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Sankar Narayana from iThought PMS. Please proceed.
Good morning, sir. Am I audible?
Yeah.
Yes, sir. Congrats on a good quarter. So my question is on the BFSI.
Sorry to interrupt, sir. Can you please come closer to your device and then speak?
Ma'am, am I audible now?
Yeah. Very much.
Yes.
Yeah.
Yes, sir. So my first question is on the BFSI vertical, which have seen good growth, both quarter-on-quarter and year-on-year. So what has been led to this rise of growth, which we haven't seen for the past 3-4 quarters, and what outlook have changed during this quarter?
Okay, the two contributing factors I would say for financial services is the technology adoption in financial services compared to our aero, defense and other industry verticals is extremely high. That has been the trend for BFSI for very long, and because the other industries are either physical hazards and the safety hazards there, which are relatively less for financial services, the technology adoption is very high. And with the advent of AI now, and as I spoke in my initial note also, that the AI and AI-infused services are clicking well with financial services who have been sitting on legacy applications, COBOL-based applications for the last 4 decades at least. And in order for them to get into a modernized application stack, the journey would have been much longer in the past. With the advent of AI, the complete migration from COBOL code to a .NET or a Java code has now become extremely simpler with only 20-25% of effort that otherwise used to be done manually. So if I have to divide that into the BFSI growth into two, one is a constant legacy modernization work is coming with the infusion of AI, and the second one is on the data and data analytics part of it is growing, and that is also a function of AI advent. With AI coming in, the underlying data is the paramount, and people are now scrambling all over the place to build data marts and data lakes and ensure that data governance is put into place, and then going into a data analytics journey. And these are the two major areas. With these two growing, what is a natural fallout for at least Expleo is the assurance part of it. The quality assurance of the new applications and the new things also is something which is our bread and butter for the last 3 decades plus, right? So as a fallout, while we are getting services on this to ensure that the business continuity due to quality of application is maintained, our QA business also has seen an uptick. So hope that answers your questions.
Yeah, got it, sir. And secondly, on the aerospace and the auto vertical, we have seen a degrowth, and you have highlighted that the auto vertical will not be growing this quarter. So what is the outlook and trend in this aerospace and auto vertical?
Maybe I will also ask Ralph to jump in here, but I will separate these two out. Aerospace, while it is shown a degrowth, that is an industry which is still a promising industry for us, and we will continue to stay invested on that. This quarter is probably a slightly difficult quarter, but we see a promising note on that front, primarily coming from our group business. Auto, regardless of our direct business, are coming from group that is going down, and as a strategy for 2026 we have decided that our strategic investments will not be on auto anymore, and but aero definitely is showing a uptick. Ralph, you want to add anything?
Yes, I can probably add a few words and give a little bit of flavor even from a group perspective. I think we all know that in the aeros segment, both in commercial aircraft and in military aircraft, we see much longer investment cycles. Same for auto than we see it in BFSI, and this in combination with some more uncertainties from a macroeconomic perspective. We even then see a slowdown in decision making, some decision points moving to the right, due to the mentioned uncertainties that probably most of the economies are facing. On our aero, I think especially even on the military aircrafts, on the investments in this segment, even in combination with the defense, it's clearly a growth segment for us at a group level, and even for ESL. But definitely the challenges in auto will continue. I think you are aware on the especially challenges of the European car makers, not only the competition from China, the tariffs from the US, a change in strategy away from pure electrification, more again into hybrid and combustion engines. All this is creating even more pressure on this segment, and therefore we do not see really a recovery there, short and mid-term on the auto side, but we clearly see it on the aero and defense segment.
Understood. And so from a more qualitative perspective, is it like all our Expleo's onshore delivery centers have reached peak capacity, and any incremental growth would be offshore to our Indian entity? Can it be a right sentence, Ralph?
I think we see that due to the overall cost pressure, there are only the minimum activities that must be considered and delivered on site will be delivered on site. All the rest will be in a global or even in a delivery model, including then the delivery centers we have. And we have them on the engineering side, Morocco, Romania, and India. And it's a straight way forward to India for all the other business segments. And this trend will definitely continue and accelerate due to A, the cost pressure that we see, and B, even the capacity that is needed to make the necessary investments in all the industries. So yes, we clearly see an acceleration there.
Got it. And finally, on capital allocation, we have a good cash balance in our balance sheet. And what is our plans going forward? Are we planning for, do we have any pipeline for acquiring companies, or we might proceed with the dividend payout which we have done last year?
Okay, maybe I'll take this question on this. On M&A front, as I updated last time, we have been evaluating several assets and finally narrowed down to 2 assets where we have just be commencing the due diligence. And this process will take at least a month and a half, and in the Jan we will know about this, and any subsequent decisions will follow based on the outcome of these acquisitions. Not Jan, I would say in Q1 of next year. Q1 of next year will definitely make one decision, and the other dividend follow-up will be based on the outcome on these asset evaluation.
Understood. Thank you, sir.
You're welcome.
Thank you. Participants, in order to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Jalaj from Swan Investments. Please proceed.
Yeah, thanks for the opportunity again. Just harping a little more on the what drove the growth specifically in BFSI. So I do understand that there is an implementation of AI which is happening around, but our initial thoughts was that the testing business should be much more impacted because of the AI, because there would be a lot of use cases to test or to automate a lot of business there. So how are things panning out there, and what explains, if you could break down the BFSI growth into maybe a traditional testing business or a newer business, something like that?
Yeah, sure. So I did mention that primarily propelled with legacy modernization and data are the ones which the banking and financial services with insurance they are looking at. So you are right when you say the quality assurance may see a decline is the thought. But in reality, let me put it this way, the word quality assurance remains constant, but what constitutes the quality assurance those days and now has totally changed. So you are right when it comes to the QA, the need for QA has been more than ever now, because you are generating today things from GenAI capabilities purely from a black box, and then the need for that, which is not coded by an individual, has to be thoroughly verified against quality than before. So that has been understood because there is significant cost gains that have come from saving development time, but at the same time, we don't know what the output is, so the quality assurance efforts have to be improved. So that the banks have realized, and then the QA has come back into the forefront. But at the same time, QA, the way it is done 5 years back, primarily 70% of the QA done manual way and 30% in an automated way, has totally changed. Today, the quality assurance definition probably still remains the same, that the application that has been developed by the developers or the GenAI has to meet the business purpose. That objective remains the same, but how has totally changed. Today, right from generation of test cases to execution of test cases and automation, all have been infused with artificial intelligence. And when I say that the QA has come back into the forefront, it is with all the levers that we have developed on infusing artificial intelligence, even in delivering quality assurance services, is the one which is the differentiator. I know that for now that may remain differentiator at this point of time, but over a period of time that also will become commoditized. So the continuity on the innovation on QA front, where we are originally the leaders, being the largest independent software testing company, we have an edge on that, and we have put all these AI-infused services which are reaping the benefit. And financial services, as I said earlier, is one of the first industry to embrace any new developing technology, and that's how we are seeing those growth elements in that sector.
Understood. So, just building onto that, so you believe that the discussions are happening with clients and the sort of pipeline you are seeing right now, the traction should continue at least until it becomes a commodity, which is going to take a longer time, because I guess a lot of now code shifts are happening towards AI, and as you correctly said that a lot of workloads which were not or codes which were written in the legacy system are being pushed to a newer language or a newer system because thanks to AI. So your net volumes are increasing because of that.
That market is a sizable market also there, because the legacy is there everywhere. They are the elephants, white elephants sitting in every major banks, and I don't see that this is something which will be over within a year. The entire legacy modernization of bigger countries like Europe and America is much higher than the emerging countries, which have the advantage of starting late, have almost got into a relatively modern technology. But if you look at the largest banks and insurance companies in both US and Europe, bulk of them, 70% of their core policy and banking core banking systems are still running in legacy platforms. So that continues to be an opportunity. And what will get commoditized is the AI infusion of QA part of it, and that part will definitely be. But this will continue to rule. My personal judgment is another several years, legacy modernization will continue to happen.
Understood. And thanks for that. And with regards to the acquisition, could you give some flavor of what white spaces or what areas are we targeting? What sort of capabilities in the target we are looking for?
So, I mean, I will give a guiding principle so that we have applied for ourselves. We want to acquire an asset which definitely has to supplement the skills that we are not as good in. Either it can be from an industry point of view, or a geography point of view, or a specific service lines. As you know, 4-5 years back, we did an acquisition which is primarily addressing two of our levers. One is the data is one area where we never had any significant presence, so that has given a shot in arm for us to put data service as a horizontal across several industries. And at the same time, that also served because that acquisition has all their customers in US. We also had a kickstart in US, which has been evading us for a while. So these are the 3 or 4 levers that we use to decide which asset helps. But it will be a complementing service, and it should be cutting across our industries will be our priority one. At this point of time, we are guiding on these principles. But as we get into a specific asset, if there is a deviation based on the virtue of the value that it brings to us, we may change, but our underlying guidelines or the levers that we want to use will remain pretty much on these things.
Got it. And sir, you partially alluded to it. So if I were to check the revenue growth and the headcount growth, they are not moving hand to hand. So should we, for our understanding of the industry or how things are now, there is a disconnect between the both of them right now? Should we understand this way, or how is the thing? Is there a non-linearity which has started to play out in at least our line of business or work?
Absolutely, and I will be very happy if this continues, because the value that we get out of each resource has to only grow up. Otherwise, the threat of remaining augmentation company is not in the vision of this company. So it has to be a more value-based, and a premium has to be given to that value, which the customers, the moment we accept, we see even the revenue growing and the headcount declining could be a general trend. And that is something which I personally see it as a highly welcoming.
So there is a possibility of margins improving from there then, from the current
Absolutely.
status at least.
The entire crux of the whole thing is we don't want to have a larger headcount with very little margins on it, and is not a sustainable one. It has to be a high margin, high value, high stickiness services that should lead this organization with higher revenue, with lower number of people. That would continue.
So any aspirations on the margin front? I'm not talking about a quarter or next year, but broadly the way things are moving in terms of the benefits of non-linearity due to AI or otherwise.
Yeah, at this point of time, very difficult to put a number, but the efforts are definitely only to improve from where we are.
Understood. Thank you, and best of luck.
Thank you. Ladies and gentlemen, in order to ask a question, you may press star and one on your touchtone telephone. We take the next question from the line of Shankar Narayan from iThought PMS. Please proceed.
Thank you for the follow-up. So my question is on our revenue guidance for the next 1 or 2 years. So during our AGM, we mentioned that we expect a high single-digit growth in this financial year, and noticing the positive uptrends across sectors and across the regions. Do you want to revise or upgrade your guidance, revenue guidance for the current fiscal year and the next financial year?
No, current fiscal year is one more quarter left with a high furlough periods. So two more quarters left, and the next quarter is going to be a high furlough period. So that will stay at where we have stated during the AGM. Next financial year, absolutely yes. I mean, we'll stick to what we said by targeting healthy double-digit growth.
Understood. Thank you.
Thank you. Participants, in order to ask a question, you may press star and one on your touchtone telephone. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you, everyone, for actively participating in this investors call, and hope your questions got answered, and we will respect your trust and thank your trust, and will continue to deliver some good work in the quarters to come. Thank you very much.
Thank you, everyone.